Welcome to the Deep Dive podcast, where we refuse to just skim the headlines. In the world of enterprise software, the stakes are too high for fluff. You need to know what's really going on beneath the surface.
Whether you're looking at a complex software implementation, improving your accounting controls, or a new security protocol, you need to understand how things really work when the rubber meets the road. I'm Ryan Caldwell. I'm here to help break down those complex ideas and systems so they actually make sense for your day-to-day.
And I'm Morgan Hale. I'm here to keep us focused on the big picture and ensure we get straight to the actionable insights you need to lead. Together, we'll talk with you like the advisors you'd hire to overhaul your tech stack.
We call this the Deep Dive. We are exploring the tools that power your business, from accounting and real estate to high-stakes security.
So if you're a CEO, a franchise director, CFO, or CTO, and you're looking for thorough analysis, you've found your home.
Let's get into it.
Let's dive in. Welcome back to the Deep Dive. Today, we are flipping the script on how we usually talk about success in the brokerage world. If you look at all the headlines, the conferences, the posts, it is always about growth. You know, recruiting more agents, opening that new office, driving top-line revenue, that's the offense.
Right, playing offense.
But today, we are talking about equity defense.
Equity defense. I really like that framing. It implies your value is under attack, which in a very specific way it actually is.
It is, because here is the reality check for every brokerage owner and CFO listening. You can spend 10 years playing excellent offense, building this amazing business, but there's a hidden mechanism that is actively eroding the value of that business right now.
And it's hiding in plain sight in the back office.
Exactly. We're calling it the confidence discount.
And just to be clear, this isn't some abstract theory we've cooked up. We're unpacking a really comprehensive review of industry findings on M&A valuation.
We're synthesizing data from some heavy hitters.
The heaviest. We've got EY-Parthenon, economic impact studies from Forrester, and valuation methodologies from the Institute for Mergers, Acquisitions, and Alliances, the IMAA.
So this is the consensus.
It's the consensus, and it's startlingly consistent. They're all telling us that buyers do not just buy earnings. They don't just look at your EBITDA number and write a check.
They buy confidence in those earnings.
That's it. That's the whole game.
And that's the mission of this deep dive, really, to understand why $1 of earnings in brokerage A is worth so much less than $1 in brokerage B.
And the spoiler alert is that it almost always comes down to whether you're running a true enterprise platform or, a collection of spreadsheets held together with tape.
Let's start there with the mechanics of valuation. I think there's a common misconception, right? You look at your P&L, you see $1 million in EBITDA, and you think, okay, market multiple is 6 times earnings, my business is worth $6 million. Simple.
In a textbook, maybe? In the real world of M&A? No, absolutely not. That's where you run headfirst into this concept of multiple compression.
Multiple compression. Okay, break that down for us. Why does the multiple shrink?
It shrinks because of risk assessment. I mean, put yourself in the buyer's seat for a second.
Okay.
They're looking at your finance operation. And they're asking one question. Is this an enterprise platform, something automated, scalable, rigid? Or is it a collection of talented people holding together a fragile process with, what we call Excel glue?
And if they see the Excel glue,
they see uncertainty. And in finance, uncertainty just. It crushes multiples. Buyers mentally start shifting your EBITDA from the durable bucket over to the uncertain bucket.
So they're asking how much of this is real?
Exactly. How much of this profit is real versus some kind of classification drift or timing issues or unreconciled balances sitting in a spreadsheet somewhere.
So they're basically just saying, I don't trust these numbers enough to pay full price.
That's precisely it. It's a confidence to multiple conversion. If I have to spend 3 months paying forensic accountants to verify your spreadsheets, I am not paying a premium multiple. I am pricing that risk right into the deal.
Let's make this concrete. The source material had a really specific valuation example that I think just nails this. Can we walk through the math?
Let's do it. So picture a hypothetical brokerage. Let's say they're doing $1.5 million in normalized EBITDA. A good, healthy business.
Okay.
Now, we run 2 scenarios for the sale. Scenario A.
The well-oiled machine.
Right. Strong reporting maturity. Automated consolidations, plain data. You can close the books in a few days. In this market, a strategic buyer sees that low-risk profile, and they might assign, say, a 7.0x multiple.
Okay, so 1.5 million times 7. That's $10.5 million enterprise value.
$10.5 million, that's our benchmark.
Now, scenario B.
Scenario B is spreadsheet dependency. Same agents, same revenue, the exact same $1.5 million in EBITDA. But the reporting is fragile. It takes 20 days to close the books. Everything is manual. The buyer sees that operational mess and assigns a 5.5x multiple.
And the math on that is?
1.5 million times 5.5 is $8.25 million.
Hold on, that is a $2.25 million difference.
$2.25 million. Gone. Just vaporized.
And just to be clear, did the agents in scenario B sell fewer houses?
No.
Did they have lower commissions?
No. The underlying business performance was identical. The operational risk was different. You lost over $2 million strictly because of a lack of confidence in the reporting.
That is a massive haircut. Now, I know we have listeners running smaller brokerages who might be thinking, well, I'm not getting a 7x multiple anyway.
That's true. A smaller firm might see a range of, 4x to 6x.
Yeah.
But the principle is identical. The percentage loss is exactly the same.
Right.
You're leaving 20-25% of your equity on the table just because you couldn't prove your numbers easily.
But the pain doesn't stop at the multiple, does it? That's just the headline price. We haven't even touched on what the sources call the cleanup tax.
No, we haven't.
Okay.
And this is where that EY-Parthenon research really shines a light on what happens during the deal structuring phase.
So we've moved beyond, I'm going to pay you less for your company, to I'm going to actively deduct money for the mess you've made.
That's a good way to put it, yes. This is the cleanup tax. When a buyer does diligence, they're calculating the actual cost to stabilize your finance operation after they buy you.
Okay.
They're looking at your chart of accounts. Is it a disaster? Do they need to rationalize it? They're looking at intercompany rules, historical cleanup.
They're literally tallying up the bill for the janitorial work they'll have to do.
And they are not going to absorb that cost. Buyers protect themselves. They might lower the purchase price explicitly, or, and this is common, they might demand an escrow or a holdback.
So I'll keep $1 million of your money until we can prove these numbers are real.
Exactly. Or they'll shift that value into an earnout, which is incredibly risky for you as the seller. So if your back office is a mess, you're basically handing the buyer a list of reasons to pay you less cash at closing.
There's another layer to this tax, though, isn't there? It's not just the one-time cleanup. It's the ongoing cost of running a manual shop. The sources call this EBITDA leakage.
Right. And this is where CFOs really need to listen up. Spreadsheet dependency isn't free. We tend to think, oh, Excel is cheap, enterprise software is expensive. But the Forrester findings on modernization, they completely flip that on its head.
Because that manual work has a labor cost. The actual human hours spent wrestling with data.
It's manual reconciliations, it's duplicate data entry, it's chasing down exceptions between systems. All of that costs real money. And here's the kicker. That cost directly reduces your margin.
And since businesses are sold on a multiple of margin, I see where this is going.
This is the multiplier effect of waste. Let's say you're wasting $100,000 a year on this administrative drag, extra staff, errors, whatever, because you won't modernize. You think, okay, I lose $100 a year.
But at the exit?
At the exit, selling at a 7x multiple, that $100,000 in waste isn't $100,000. It is $700,000 in lost enterprise value.
Ouch. Every single dollar of waste gets amplified 7 times when you sell. That really puts the cost of new software into perspective.
It changes the ROI calculation completely. You're not just buying efficiency. You are buying valuation protection.
I want to pivot to the human side of this for a minute, the psychological part, because deals are done by people, and people get tired.
Diligence fatigue is a very, very real phenomenon, and it kills deals.
What does that look like in a spreadsheet-dependent brokerage? I imagine the buyer starts asking for a lot of data.
It looks like a scramble, a chaotic, stressful scramble. The buyer asks for a standard report, say, a normalized EBITDA bridge for the last 24 months. If your reporting is person-dependent, you can't just click a button. You have to go build it.
You have to find the files.
You have to remember why you made that weird adjustment in November of last year. And while you're doing all that, the clock is ticking. The deal momentum just slows to a crawl.
And in M&A, time is the enemy.
Time kills all deals. When diligence drags on because you can't produce the data, you enter the retrade risk zone.
The retrade. That is the nightmare scenario for every seller. Can you explain that?
A retrade is when the buyer comes back at the 11th hour, right before closing, and lowers the price. They'll say something like, well, given the uncertainty we've uncovered, or just how long this is taking, we need to adjust our offer.
And the IMA specifically links this to technology gaps, right?
They do. They point out that these gaps create deal risk. If you can't produce the data, the buyer starts wondering, what else are they hiding? If they can't even show me the commission splits instantly, do they even know what they are? The delay breeds suspicion.
And suspicion costs you money.
A lot of money.
Now, we're talking specifically to brokerage owners today, and the source material suggests this audience is particularly exposed to this problem. Why is a multi-entity brokerage more vulnerable than, say, a manufacturing plant?
It all comes down to complexity. We call it the multi-entity brokerage amplifier.
Okay.
A brokerage isn't just one clean P&L. It's often a holding company with multiple legal entities, different offices, maybe a property management arm, an insurance arm.
And money is just flying between them all the time.
Constantly. Complex intercompany cash flows, expense allocations, and then you have the sheer transaction volume and the commission plans.
Oh, don't even start on commission plans.
That is the single biggest pain point we see.
Yeah.
Brokerages using these massive Excel file-based commission programs because no standard software can handle their quirky comp structure.
So they build a monster spreadsheet to track it all.
They do.
Yeah.
And then they try to shove these summary numbers into QuickBooks or a general ledger.
And the buyer looks at that and just sees a black box.
A total black box.
Yeah.
Buyers don't want pretty financials. They want repeatable financial truth. They need to be able to drill down by entity, by office, without having to do, and I love this phrase from the source, forensic spreadsheet archaeology.
Forensic spreadsheet archaeology. That is a terrifying phrase. It implies digging up bones.
And in diligence, if you dig deep enough, you usually find a few skeletons.
So let's help our listeners avoid the skeletons. Let's talk about being diligence ready. What's on the checklist? If I'm a well-run brokerage on paper, what can I produce instantly?
Okay, there are a few requests that are routine for buyers, but will absolutely break a fragile system. Number one, trailing 24 months by month.
Consolidated and by legal entity.
Both.
Yeah.
Instantly. If you have to manually stitch that together from 24 different Excel files, you're already in trouble.
Okay. What else?
Intercompany schedules and elimination logic. This is huge. The buyer needs to know that money moving from entity A to entity B didn't get counted as revenue twice.
Seems basic, but I imagine that gets messy fast.
Incredibly messy in a spreadsheet world. Next, reconciliations.
All of them.
All of them. Cash, AR, AP. But the big one for this industry, commissions payable and accruals. That liability can sink deals. If you don't have a perfect handle on what you owe your agents at any given second, your balance sheet is basically wrong.
And the EBITDA bridge.
Essential. And you need consistent normalization rules. If you adjust owner comp one way in 2024 and a different way in 2025, that's a red flag. They want consistency.
And I'm guessing speed matters here too.
The close calendar. If you can show a buyer, we close our books in 5 days, period lock controls are on, here's our cadence, that signals control. If you say, we close whenever we get around to it, that signals major risk.
The source material had this little vignette that I think a lot of people will recognize. The brokerage using an Excel commission program next to QuickBooks for bookkeeping.
The classic disconnect. The swivel chair integration, where you look at one screen and type it into another.
And the result was always a remediation burden.
Always. Because the data never transfers perfectly, you end up with these lump sum journal entries instead of detail. So when a buyer asks, show me the margin on this specific office, you can't. The source was clear. When reporting maturity lags operational complexity, somebody has to pay to fix it.
And it's either the seller paying pre-close to clean it up,
or the buyer paying post-close and just deducting that cost from your check.
It seems like the days of handing over a stack of tax returns and a smile are long gone.
Long gone. The market is just too sophisticated. Private equity, strategic buyers, they have teams of analysts whose only job is to find these cracks. They are professional risk hunters.
So let's bring this all home. We started this talking about equity defense. What's the final synthesis here? How should a brokerage owner change their mindset today?
I think you have to stop viewing your finance operation as just a utility. You know, it's not just about paying bills and filing taxes. Modernizing your finance operations, moving from spreadsheets to a real platform. That's not an IT upgrade. It's a strategy to protect your valuation.
It's an investment in your exit price.
It absolutely is. In a market where diligence is this unforgiving, eliminating spreadsheet dependency is the most direct way to reduce that perceived integration cost.
Yeah.
You are literally buying back your own multiple. You're taking that 5.5x offer and pushing it back up towards 7.0x.
That is a powerful way to frame it. You aren't buying software. You are buying a 1.5 turn increase in your multiple.
Exactly. And you're buying certainty.
I want to leave our listeners with one final thought to chew on. We've talked a lot about the technical side, but there's a really strategic question here.
I think the question is this. If you look at your back office right now, today, do you see a cost center or do you see a risk surface?
That's good. Risk surface.
Because if you were to put your business on the market tomorrow, would your finance operation behave like a scalable enterprise platform that actually adds value? Or would it reveal itself as just a collection of really talented people holding together a very fragile process?
That is the question. And frankly, it's better to answer that for yourself now than to have a buyer answer it for you in the middle of due diligence.
Absolutely. Find your repeatable financial truth before they do.
That's it for this deep dive. A huge thank you to the insights from EY-Parthenon, Forrester, and the IMA for grounding this discussion. We hope this helps you look at your spreadsheets a little differently tomorrow morning. Thanks for listening.
Goodbye, everyone.
Sweet sugar pop, rocks and pop. You don't stop till the sweet beat drops. I shall improve as I stick and move. Vivid poems recited on top of the groove. Smooth mind, floating like a butterfly. Notes set afloat, sung like a lullaby. Brace yourself as the beat hits ya. Dip, trip,